Hey guys, welcome back to Module 17. It's our final chapter. We're going to be using relevant cost and differential analysis for decision making. So not every cost matters to every decision. That's our final chapter, and in many ways it's going to bring together everything we've been building toward. So in chapter 14, we said managerial accounting provides information for internal decision making. In chapter 15, we learned how costs behave. And in chapter 16, we use cost behavior to understand how changes in price, volume, and cost affect profitability. And now we're going to ask, when managers are choosing among alternatives, which information should actually affect the decision? Sounds simple, but one of the most common mistakes managers make is including information that doesn't actually change between alternatives. So our manager's lens for chapter 17 is what changes if I choose one alternative instead of another. If you remember that question, you've understood the central idea of the chapter. So looking at relevant versus irrelevant cost, let's define them. Relevant costs are future costs that differ among competing alternatives. Notice both parts of that definition. The cost must relate to the future, and it must differ between the alternatives. If a cost will be exactly the same, regardless of which alternative we've chosen, then that cost generally isn't relative to the decision. Suppose we're deciding between machine A and machine B. If both alternatives require the same $50,000 annual facility cost, that $50,000 doesn't help us choose between them. It occurs either way. But if machine A requires $100,000 of labor and machine B requires $70,000, that difference matters. That's why relevant cost analysis can actually simplify complicated decisions. We don't necessarily need to analyze every number. We need to focus on the numbers that change. So from a manager's perspective, more data doesn't always mean a better decision. Managers today have enormous amounts of information, but more information doesn't automatically produce a better decision. Imagine I give you guys a spreadsheet with 200 cost items. Only 6 of those items actually differ between the alternatives. The other 194 may make the analysis look sophisticated, but they may also distract you from what matters. Relevant cost analysis forces us to ask, what is the difference because of this decision? It's an extremely useful discipline, well beyond accounting. So, sunk cost. That's an important concept because a sunk cost resulted from a past decision and cannot be changed by the decisions we're making today. The chapter is very clear. Sunk costs are never relevant to the current decision. Suppose your company purchased a machine 3 years ago for $1 million. Today you're deciding whether to replace it. The original million feels important. It was a lot of money, but can today's decision change the fact that the company spent it? No. The $1 million is gone regardless of whether we keep or replace the machine. So the historical acquisition cost is not relevant to the replacement decision. What could be relevant? The machine's current disposal value, future operating cost, the cost of the replacement machine. Those costs or those amounts may differ depending on what we choose. So managers would say, well, we've already spent $1 million. This is where human behavior can make good decision making difficult. Imagine a project is clearly failing. Management says, we can't stop now. We've already invested $10 million. Ask yourself, does continuing the project somehow recover the $10 million you already spent? If not, that does $10 million shouldn't determine what we do next. The better question is, from this point forward, which alternative gives us the best economic outcome? The PowerPoint even notes that sunk costs can create ethical and behavioral dilemmas, mainly because managers may resist disposing of assets or obsolete inventory when doing so creates an accounting loss that makes their performance look unfavorable. That's a very real managerial issue. Opportunity cost. Now let's consider almost opposite ideas, opportunity cost. An opportunity cost is the benefit we give up when we choose one alternative instead of another. And unlike sunk cost, The chapter emphasizes opportunity costs are always relevant when choosing among competing alternatives. Suppose your company owns a warehouse, you could use it for a new product line, or you could rent it to another company for $200,000 a year. If you use the warehouse yourself, you don't write a $200,000 check, but you're giving up $200,000 of rental income. That foregone benefit is an opportunity cost of the warehouse. That's an important reminder that some economically relevant information may not appear in the accounting records at all. When we talk about differential analysis, this focuses specifically on the cost and benefits that differ among alternatives. I like to think about it really simply. Alternative A produces one set of future revenue and costs, and alternative B produces another. We're interested in the difference. This keeps us from being distracted by amounts that remained unchanged. And that's why differential analysis is often preferable to comparing two complete income statements with large amounts of identical information. So we want to focus on what revenue changes, what cost changes, what cash flow changes, what opportunity do we gain or sacrifice. Then consider the qualitative factors that don't fit neatly into a spreadsheet. So now we talk about when do we replace equipment. Suppose we have an old machine and we're considering a new one. The old machine's original cost is sunk, but several other amounts may be relevant. The purchase price of the new machine, the amount we could receive by selling the old machine today, differences in future economic or future operating costs, and possibly future salvage values. So the question is not which machine has the lower accounting book value, it's which alternative produces better future economic outcomes. It's a very different way of thinking. So from a manager's lens, don't let the old decision make the new decision. The principle extends far beyond equipment. Managers inherit previous decisions all the time. Old technology, old facilities, acquisitions, products, software systems, strategies. The fact that an organization spent substantial money on something in the past does not automatically justify spending more money on it in the future. Each new decision should be evaluated based on its future consequences. So should we discontinue a product or a segment? Another major Chapter 17 application is really deciding whether to discontinue a project, a department, or a business segment. And this is where allocated fixed costs can become dangerous. Suppose a product line reports sales of $100,000 or variable costs of $80,000 and allocated fixed costs of $35,000. On paper, the product appears to lose $15,000. So perhaps someone says, let's eliminate, but look more carefully because the product generates $20,000 contribution margin. So even though it's losing some money, it's been absorbing some contribution margin. So suppose only $10,000 of the fixed cost will actually disappear if we discontinue the product. If we drop it, we lose $20,000 contribution margin, but save only $10,000. Overall, the company profit fell by $10,000. And that's exactly the logic that is reflected in the Chapter 17 portion of your final exam. So the product is losing money. Whenever someone says this product is losing money, so we should discontinue it, I'd want to ask which costs actually disappear if we do discontinue it. If allocated corporate overhead simply gets reassigned to the remaining products, eliminating the product doesn't eliminate that cost. This connects directly to what we discussed in Chapter 15. Allocated costs is not necessarily avoidable costs. The distinction can completely change in a managerial decision. Make or buy outsourcing. So managers also frequently decide whether to make something internally or to purchase it from an outside supplier. This is also often called a make or buy or outsourcing decision. Suppose a supplier offers to produce a component for $15. Your accounting system says it costs you $17 to manufacture internally. Should you outsource? Maybe, but first ask, what portion of that $17 will actually disappear if we stop producing the component? Direct materials might disappear, direct labor might disappear, some overhead might disappear, but perhaps allocated factory depreciation will remain. If the cost remains regardless of the decision, it generally isn't relevant to the comparison. So your Chapter 17 assessment specifically reinforces that unavoidable allocated fixed overhead is irrelevant when it continues under either alternative. Looking at it from the manager's lens, cheaper isn't necessarily best. Even if outsourcing produces a lower relevant cost, we're not finished. We also need to consider supplier quality, reliability, delivery times, intellectual property, employee consequences, supply chain risk, and strategic control. So your Chapter 17 materials explicitly include qualitative consideration along with the quantitative analysis. That's important. The spreadsheet informs the decision, but it doesn't make the decision. You get lost in the numbers and you don't see the big picture. Special orders. Another common decision involves special orders. Suppose your company normally sells a product for $60 and a customer offers to purchase a large quantity for only $42. Should you reject the order because $42 is below the normal selling price? Not necessarily. Suppose variable cost is $31 per unit. The company has idle capacity, and accepting the order won't increase the fixed cost or interfere with normal sales. The special order provides 42 minus 31 equals $11 of incremental profit per unit. Based purely on the quantitative analysis, the order could increase profit. The exact logic is reinforced in Chapter 17 through the assessments. But again, we need qualitative considerations. Will regular customers demand the same lower price? Could the special order damage the brand? Will it interfere with existing customers? Could it lead to future business? Relevant cost analysis gives us the financial starting point. But the manager is going to say, we're selling below full cost, and someone may object, but $42 is below our full cost per unit. That may be true, but if some of that full cost consists of fixed costs that won't change whether we accept that order or not, those allocations may not be relevant to the short-term decision. That doesn't mean companies should routinely sell below full cost, but long-term pricing has to support the entire business. But for a specific short-term decision involving idle capacity, the relevant economic question can be, again, different decisions, different relevant information. When we're talking about constrained resources, the chapter also addresses situations where companies face a scarce or constrained resource. Maybe machine hours are limited. Maybe skilled labor is limited. Maybe production capacity is limited. When that happens, managers shouldn't necessarily prioritize the product with the highest contribution margin per unit. Instead, they should generally focus on contribution margin per unit of the constrained resource. Suppose product A generates $40 of contribution margin and product B generates $30. At first glance, product A looks better, but suppose A requires 4 machine hours while B requires only 1. Product A generates $10 of contribution margin per machine hour and product B generates $30 per machine hour. If machine hours are the constraint, product B may deserve priority. So your final exam will explicitly test that logic by ranking products according to contribution margin per machine hour. Quantitative analysis isn't the final decision. And I want to end the chapter with something that is especially important for MBA students. A relevant cost analysis helps us identify quantitative economic consequences of alternatives. but the chapter explicitly reminds us to layer qualitative information into that analysis. Suppose outsourcing saves $500,000. That sounds attractive. But what if the supplier seriously or has a serious quality problem, or significant geopolitical risk, or poor labor practices that could damage your company's reputation? Or what if outsourcing eliminates capabilities that are strategically important to the company? Those issues may not fit neatly into an Excel spreadsheet. They still matter. Chapter 17's framework specifically acknowledges long-run profit effects and non-qualitative consideration such as legal, ethical, and social factors. So the managerial process is not calculate equals automatically choose. It's identify relevant information, analyze the financial consequences, consider qualitative and strategic factors, and make the decision. So, as we conclude chapter 17, I want you to understand the definition of relevant cost. It is a future cost that differs among alternatives. Also, remember the two rules that summarize a large part of the chapter. Sunk costs are never relevant, and opportunity costs are always relevant when choosing among competing alternatives. Also, you need to understand differential analysis, which focuses on revenues, costs, and benefits that actually change between alternatives. And fourth, you need to apply the thinking to equipment replacement decisions. Don't let the historical cost of an old asset drive a future decision. Fifth, when evaluating whether to discontinue a product or a segment, determine which costs are actually avoidable. Allocated costs that remain after discontinuation do not become savings. The next thing is in make or buy decisions, you need to compare the relevant cost of producing internally with the relevant cost of purchasing externally, and consider the opportunity costs associated with capacity. You also need to evaluate special orders using incremental revenues and incremental costs, while also considering capacity and qualitative consequences. When a resource is constrained, you need to focus on contribution margin per unit of the constrained resource. And finally, don't let the spreadsheet make the decision for you. Make sure you're considering beyond math. Relevant cost analysis helps managers determine the financial consequences of alternatives, but managers have to consider quality, reliability, employees, customers, risk, ethics, and long-term strategy. So if there's one question I want you to remember from chapter 17 and perhaps from the entire managerial accounting portion of this course, it is what actually changes if I choose this alternative? And ask another, what matters that isn't captured by the numbers? Those two questions together are at the heart of good managerial decision making, and they're really what we've been working toward throughout the second half of this course. You guys have been a great class. I've enjoyed having you. If you ever need anything, feel free to reach out. I'm going to help you however I can. Best wishes to you as you move forward. You guys take care.